But if you calculate it on an equal weighted basis, then it's only 3%. What's your view on that?
Yeah, I think you have a very good point. I mean, usually is if when the market breadth is not that wide enough. I mean, it's concentrating a small number of large cap stock, and that of course is that the risk is higher because it's any hiccup in any one of those companies, and then we drag down the whole market.
Hi, welcome to The Curious Investor, the show where we break down complex financial topics and help you make informed investment decisions. I'm here with our strategist, Redmond. Redmond, thanks for being here.
Thanks, Lana. Thanks for inviting me to the show again.
So today we will be diving into the topics of the recent U.S. stocks rally and also how we can see in the future, in December, what investors can do.
Yeah, I mean, it's in November, the market has been doing pretty well. And I think mainly is because we have a rather soft inflation numbers from the US. And also the job data is also a little bit weak. So that also is the Fed Chair Powell also to turn a little bit of a dovish in his, the communication. So all this give a lot of hope. And that is the Fed probably, is the hiking cycle has already come to an end, and next year's and they will start cutting rates. And also is we have also been seeing the third quarter earnings, and so far it's 94% of the company of the S&P 500 has already reported, and 82% of them and actually say reported earnings better than expectations. So. And the kind of a blended growth rate, earning growth for the third quarter is about 4.3%. That is also better than expected. I mean, back 2-3 months ago, the market is expecting pretty much flat kind of earning growth. So, I mean that has given some support to the market, and so we have seen, it's quite a decent rally, yes.
Redmond, do you think the growth can be sustainable?
Yeah, I tend to think so. And of course, provided on December 8th and non-farm payroll number will not have much surprise. And also you have the CPI also on December 12th. And both will be before the December 13th FOMC decision. I mean, unless those are really major upside surprise. Otherwise, if the Fed will not hike rate, they will put on hold. And most likely on the communication, I think Powell pretty much will say a little bit more dovish side and try to pave the way for next year's rate cut. So, and provided, as I said, no major surprises there, I think the market can actually sustain this kind of rally. And also important is usually there's some seasonal factors here as well. Usually around Thanksgiving time and also December. And those who are actually is on average tend to be the market tend to do quite well in November, December. So, and there's some support there. And also in terms of earnings, I mean, and now the analysts expecting up more than 11% year-on-year increase in earnings for 2024. So unless there any major downward revision, which we don't foresee for the time being, and probably that will happen in 2024, but in the next few weeks, I think towards the end of the year, it's probably those outlook for better earning growth next year that probably will still continue to support the market.
So why do you think the Fed would not wait longer before they make a move?
Yeah, I think we talked about it before a little bit, but I think we can go deep a little bit at this time. Is I think the one of the things is the federal government of the United States actually, is running such a huge deficit and have so much debt at this current interest rate level, and it would be a problem for them to afford such interest payment. And I think one recent incident is the Moody's and changed the credit rating outlook for the U.S. and from stable to negative. One of the major reasons is actually they said it's under at this kind of interest rate level, And even the 10-year interest rate later on may be coming down to 4%, still is the debt level, I mean, the interest payment every year is very difficult for the government to sustain. So that's a need for the Fed to help the government to finance the deficits. They try to keep the long-term interest rate at more moderate level. And give you some number, I mean, the U.S. government now, federal debt about $34 trillion. And then the Fed also are paying, so last time talked about the Fed also paying interest on some of the reserve and also some of the reverse repo for the money market fund. That amount to about 4.5 trillion. So altogether, you are talking about 38.5 trillion kind of interest paying liabilities for the Fed and also the federal government. And so if you talk about the current interest rate level to refinance, to keep financing those debt, you're talking about more than $1 trillion or more than 1.5 trillion kind of interest payment every year. And according to Moody's estimate that, that is basically, that is account for by 2020, 2033, that would become 4.5% of GDP and only the interest payment. And that would become something like 26% of the whole revenue of the government. So that's not sustainable. So the Fed probably will use this window opportunity when inflation is being now moderate a bit. And I mean, they can always say that's due to the long and variable lag. I mean, they can actually start cutting rates and wait for and then the inflation coming down on the right trend, the right direction. And very important, we also talked about before, since 2020, the Federal Reserve has adopted a new framework, right? I mean, they are not targeting 2% as a cap. I mean, they are at the 2% is only a number on average. And they have not explained or specified how many years to calculate the average. They actually explicitly say for some years they can let the inflation rate overshoot, because in some year that will be undershoot below 2%. So on average, it's around 2%. So they have all kind of explanation or reasons they actually can start cutting rates. And also, that's more important is the next year. You remember that's an election year, and the Fed is under a lot of pressure, of course, from the administration side to make sure the economy is not running into recession. And the recession rate is still here, especially we think that for Saxo, we actually think that there's quite not eligible, ineligible kind of probability for a recession next year. So the Fed is under some pressure to avoid that, and also, but you remember the election is in November. So I know there's quite a number of economists saying that maybe the Fed will wait until September to do that. I think that's too close to the election day. You don't want to give an impression that they cut rates. You cut rates because of the election, so you want to do it earlier. And then now the market's pricing around the first one will be, if you look at the futures market, about I think in May, June, around that time, the first rate cut. And as actual, I think that maybe there's even possible that is probable that they probably will do it in the first quarter.
Then what are the risks that can jeopardize this rally?
Yeah, I think the risk is we mentioned about if there any surprise is a sudden jump again in the CPI or PCE. And I think that's the most important risk. Or the non-farm payroll become very, very strong again. These are the two risks. And also, we will not be seeing much earnings until for some time. So that the earnings disappointment probably will not be a major risk. But if analysts start revising down aggressively on earnings, that earning momentum turn very negative. That will, of course, would be another risk if something happen. Because if you look at we mentioned about the third quarter earnings, the results were pretty good, but the guidance actually were rather weak. Quite a number of companies have given out quite some negative guidance, so they are not too optimistic. So if some analysts, if analysts start revising down more aggressively, then down the road maybe there's one of the risks to the stock market.
There has been a concentration on the Magnificent Seven, and would that pose a challenge to the rally? And also, I think this S&P 500 has risen about 18% this year for now. But if you calculate it on an equal weighted basis, then it's only 3%. What's your view on that?
Yeah, I think you have a very good point. I mean, usually is if when the market breadth is not that wide enough. I mean, it's concentrating small number of large cap stock, and that of course is that the risk is higher because it's any hiccup in any one of those company, and then we drag down the whole market, and also means that maybe the other company are not doing that well. So that I think you have a very good point on that. But I just want to mention that okay, the November rally actually is you have been seeing even the eco weight is about it's a slightly little bit less than 7% in November, the performance, and then the market cap weighted is the regular S&P now we are talking about around 7%, so very similar. So the smaller cap is already, I mean not smaller cap, but the other company within the S&P 500 also catch up a bit in November. And if you look at small cap, the Russell 2000 actually did even better. It's actually up about 8%, and so far in November, and so a little bit more widespread, and also because I think that now it's more like soft landing kind of scenario, and so more not too hot, not too cold, and Goldilocks, and that's the small cap also catching up a bit. So the number one, so the market now is not less extreme in this recent move, and the second thing is I think I mean it's the Magnificent Seven. I mean there's of course there's reason for them to be doing well as well, because the expected revenue growth has been quite good for them, and they have been delivering so far. And then they have higher margin, stronger balance sheet, and that's where this kind of attribute is very important when you have to consider throughout 2023 the interest rate was going up, and then is especially during the first part of the years, people were debating whether there would be a recession, and there's a lot of recession fear. And then you have the bank failure, a number of bank failure in March. You have also war and so on. So it's a lot of uncertainties in the market. So people tend to stick to, I mean, those kind of this type of larger cap, and then those also have a stronger balance sheet, and also have at least expected high growth. And so. And also, I also want to emphasize is it's very important to have a narrative. I mean, when it's uncertain, and I mean, for looking, I mean, I'm a value investor. I mean, I focus on valuation, but at the same time, is when the market is a little bit uncertain, the outlook's more uncertain, and those companies have a good narrative. Like those Magnificent Seven. I mean, each one of them have a good story. So that actually help investors in making the decision and easier. So I mean, that actually been helping them. For example, like Tesla. I mean, if you look at it as a car company, it's very expensive. Then there's no doubt about it. But then investor, of course, you look at okay, what's the potential growth in the self-driving. It's a car. I mean, it's technology and also AI as well, as you said. I mean, Tesla is also giving AI and also the self-driving, and all those is also all those. So those are the growth, and of course that gives a narrative for investor to give higher valuation. But of course, this is, I think, in the near term, we don't see any trigger catalyst to maybe to trigger the any downward revision of the valuation. But we agree. I mean, there's a lot of risk there. I mean, and then it's next years. I mean, where if the economy actually really slowing down, and then is when I mean they cannot really deliver the growth being priced in, and especially we talked about that before. AI, the profitability or commercialization of AI will take years to come. So all those things, and probably you will the competition also heating up. I mean, it's you back to the Tesla. I mean, EV is not. I mean, it's the barrier to entry actually is smaller than the traditional car. So and all this will pose some risk in longer term or medium term. But in near term, I mean, is the narrative actually help them to perform better than the other companies. So I think so just a yes or no, and I hope I can answer your questions. Yeah.
How about liquidity?
Mm.
Not too long ago, there are a lot of concerns about the decline in liquidity, including the Treasury. They are issuing a lot of debts, and also the Fed's the QT that they have.
Yeah. I mean, you're absolutely right. I mean, even today, still some concern about what's going to happen about liquidity, and concerning about the point. But let's look at some numbers. Yes, I mean the Treasury has been issuing quite a lot of debt. That's true. I mean, it's like they will issue more, and the Fed continues to do the quantitative tightening, the QT, and that is 95 billion a month. But if you look at the number, actually the bank's reserve, I mean those bank have the reserve with the Federal Reserve actually has been increasing in November. I mean it's also, in fact, it's now it's 3.48 trillion. That is actually back to higher than the March level. I mean, so that we serve at the bank, the bank's reserve at the Fed have not come down. Actually, it's gone up. And even though the Fed has been doing quantitative tightening, taking money, taking the liquidity away, and the Treasury issuing debt, and they're also absorbing some of those liquidity from the market. But that the main reason for the increase in those reserve, bank reserve at the Fed, which is actually liquidity for the bank to lend out. They can lend out because those are reserved at the bank. They can at the Fed, the bank can lend out to create liquidity. So two things. One, the money market fund, and they have basically cut down a lot of the investment in the reverse repo at the Fed. Those are the fund the money market fund they put at the Fed. So that has come down from 2 trillion to now below 1 trillion. And they use those money to buy Treasury bills and so on. They actually absorb what you mentioned, the Treasury issuance of more debt. So the money can take the money away from the Fed to go and then buy those Treasury bills and so on. So the money move from the Fed back to the banking system. So that is an injection of liquidity. And then also the Treasury themselves has been spending some of the money. I mean, it's not just 1-2 months ago. I mean, you have been about around 800 billion kind of money they have in the TGA or the Treasury General Account, i.e., I mean, basically it's the bank account the Treasury has with the Fed. So this now is about 600 something billion. So they have been spending some of those money. Only in November they spent something like 83 billion already. So all this together, that means offset that they take liquidity drain. Apart from the QT and also from the debt issuance. So liquidity actually, at least at the bank themselves, more money they can lend out. So that is not really I mean, there's some concerns still be around, but it's not really a problem for the market because the bank actually sitting on a lot of reserve they can anytime lend out to for loans or for investment activities.
So in conclusion, you have said that there might be a potential rate cut in Q1 2024 due to several reasons, including the low employment data, low inflation data, and also there are U.S. needs, the government's needs to refinance, to refinancing, and also the coming election year. So I think the Q3 earning is quite good. So we can look forward to 2024 as well. And there are also seasonal patterns and some of the factors that you just mentioned. So we think for the remainder of this year, it still might be quite good in the market, right?
Yeah, in the near term, I think you have given a very concise summary of our perspective. Of course, there's some risk we have already talked about for 2024, but basically in the near term, I think you have given a very concise summary. I think that's exactly what we are thinking.
Yeah. So thanks for watching today and stay tuned to our Curious Investors series. Thank you.